Welcome to The Lumber Word, where industry veterans Matt Beamer, Gregg Riley, and Ashley Buckhold dissect the world of commodity lumber each week. We bring you up-to-date insights on supply, demand, and market trends, sharing our trading expertise to benefit everyone in the supply chain. Join us for informative and entertaining discussions that guarantee to make you wiser about all things lumber.
Hey, everybody. Welcome to this week, episode number 12 of The Lumber Word. It's going to be a great episode. Had some great feedback so far. This is a show where we talk about everything lumber. We have guests. We have a great guest today. But first, I want to do the disclaimer. Everything that we talk about on this show is our own ideas. Gregg, how do you like to say this? Don't do what we do.
Yeah. Just because we say it doesn't mean you should do it. If we tell you to jump off a cliff, don't do it.
Real cool.
I know we're an industry throw of lemmings just looking for that next cliff to go off. So it's a good disclaimer, Ash. A really good disclaimer.
Thanks. Well, hey, look, we're going to jump right into it. We're excited to have Kyle Little, COO of Sherwood Lumber, also a CNBC contributor. You've probably seen him on TV before. Kyle, Gregg, and myself go way back. Kyle's been in the industry. Just real quick, Kyle, why don't you give just a brief 411 on, we've got a lot of similar background. We've known each other for a long time. We're excited to have you on.
Hey, thanks, Ashley. Thanks, Gregg, for having me. Been in the industry for quite a long time now, pushing 25 years. Prior to that, growing up in a family-owned and operated sawmill and remanufacturing and retail lumberyard. So sawdust really kind of runs through the veins, and the apple doesn't fall so far from the tree, or the limb doesn't fall right now so far from that tree. Stayed in the lumber business, just a great industry. Had the opportunity of doing a lot of different things, from a buy group to brokerage wholesale to now working with a wholesale distribution company. I've been here at Sherwood Lumber for just under 15 years.
What?
Yeah, seems like a long time, right? Yeah, 15 years.
Man.
It's 2009. So, really excited to continue to help our organization transition into its third generation. Continue to navigate this wonderful lumber and building materials world that we operate in every single day. It's something to learn all the time.
So, Kyle, I'm sitting in my office yesterday, and I hear Gregg. We're all excited. We're like, hey, we got Kyle on tomorrow. It's going to be cool. And Gregg, what'd you mention about seeing Kyle and his family on the beach?
Oh, yeah. No, I was talking to somebody, and then, we're on the beach in Hawaii, and then I'm walking down the beach, and there's Kyle and his family. I'm like going, God, what a great business to be in.
That's awesome. That's awesome.
I said my oldest son talks about that to this day, because I go over and I hug this guy, and he's like, Dad, what's going on?
That's great. That was so probably out of context.
I want to know how your golf game is. I mean, I don't care about what you think about lumber. What's your golf game like right now?
I got my handicap's the best it's been in probably the last 2 or 3 years. My index is just I think 2.3 right now.
I hate you.
But I'll tell you, all the guys I play with, I get smoked. I mean, some of these guys are just plus handicaps, and they bomb it by you 20, 30 yards all the time. It's crazy. The golfers out there today are just really talented.
Well, welcome to my world. I'm usually 40, 50 yards behind the guys, and I'm hitting a hybrid, and they're hitting a wedge into the green. I'm like, can't compete.
Yep.
With that. Yeah.
But I feel similar to that.
Plays too, doesn't he?
He does. He just played in his conference championship, and he qualified for the Suffolk County tournament, which is in a couple weeks. So he's very excited about that. He's a senior this year in high school and trying to finalize his college search and make his decision to go to the next level. Not to play golf though. We joke about, my wife and I, is that we're raising mathletes, not athletes.
But that's the hardest sport to watch one of your kids play is golf. Because you just hang on every shot, something goes off, and I'd much rather play basketball or hockey or anything, because it's moving so fast, you're already past it, right?
Yeah, and in golf in high school, it's not match play, it's stroke play, so it's and there's no gimmies in that game, so it's tough.
No, gotta putt everything out, man.
Yep. So Kyle, Gregg just got back. He was over in France for a week. So
wow.
Glad you're back, Gregg. How was that?
Comment ça va?
Are you speaking Montreal French, or are you speaking French?
Oui.
Sorry to all the people in Montreal. They try to explain there's a difference between some of it. So I guess the question is, housing starts and permits came out this week. And what we'd like to talk about in this episode, and what we do talk about, we really are just trying to figure out where this thing's going, right? And this is a good, Greg, you always put it real well. We kind of do it because it's a good way to bounce ideas off each other and talk about the things that we don't know, so to speak. After getting back into it again, Kyle, after being out of it, my God, there's still a lot of things I don't know. So the one thing I looked at on the housing starts report that I thought was really interesting, and Gregg, this is your idea. He's like, hey, look at the...
Actually, you went like this. You went like this.
If you're just listening on a podcast, that's the axe chop with the hand. The home's under construction right now, right? So when I look at it, if I'm trying to pull out a chunk of gold or something to hang on to, I'm looking at completions, even non-seasonally adjusted completions, 1.694. I mean, that's pretty good, right? I mean, that gives us, this is just on new construction, that gives us some still continued pull through in the pipeline. Am I reading that right, guys?
Absolutely. I think there's a tremendous amount of job things to be completed and ones that just got underway really in the last 3 to 6 months. So in many cases, the what I'm seeing in the field, it's not doom and gloom. There's enough to keep people busy. While it's not up to what it was 2 years ago at the peak in 2021, but it's still, historically speaking, pretty solid. Like the smaller builder seems to have an okay order file. Maybe not as good as it was like we just previously saw, but it's okay. One of the things that I've been trying to do over the last 2 quarters, because it is a little bit more challenging out there, and it's not like the hectic nature that we have, just try to travel and see what's going on in the marketplace. And it really depends where you are around the country, but generally speaking, the takeaway and the amount of business that the builders have and the retailers therefore have is okay. It's not like great, but it's okay. And I think that's the numbers reflect that in the housing start numbers today. Like if you look at them where they are today, over the majority of our career, we would say this is pretty decent business. But we just came off of 1.6, 1.7, right? And now we're trending below 1.4. So it kind of like is a little bit more tighter than what we've experienced.
Yeah. So one thing when I looked at those, the completion numbers that I brought that highlighted for me is if I look at single family from a year ago, under construction is down 14.8%, and multifamily is up 10.9% from a year ago. That tells me two things. One is builder cycle times have increased, which combination of factors of labor, material shortages no longer, so they're able to build quicker. The surge in multifamily, and to Kyle's point, you can't tell you, the number of jobs that are, and it's disproportionate that they're follow-up purchases, not new jobs starting right now. And I guess if I'm gonna do one thing in the next, few weeks, is really get my finger on what does it look like for jobs that are going to start in December or Q1. What does Q1 multifamily look like? I'm going to need to dig into that. And, any of our listeners, ping me, let me know what you think.
I would just add to that, Greg, like we saw in the middle of this year, virtually no interest in forward price or job activity to lock in, for the first quarter of next year. It really wasn't up until maybe like 60 days ago, maybe 45 days ago, that we started to see those inquiries resurface. And not all of them have been committed, but at least we're starting to see that there are some jobs out there that possibly could be committed here in the very near future. So, but I would say it wasn't until maybe August of this year that we were able to lock up our first 2024 project, which was to me like it was very, like, it was concerning. I was like, what's going on? But now it starts to feel like it's getting a little bit better.
Big challenges that I see on multifamily right now is trying to take guys would want to be so close to today's market for Q1. And as you know, the numbers do not work for that.
But Greg, I thought forward pricing you could discount in the future. That's what we've always heard.
There are times when you can discount in the future. This is a time. Q1, there is a pretty substantial creep, depending on the item. Some are more than others, but Q1 pricing is a good premium to today's cash price. That's for sure.
Tell me how discounting undervalued items works, and let me know how well you do on that.
Sounds like that's a good way to go broke.
Yes.
So just a quick question to follow up on the homes under construction, multifamily versus single family. So we know entry-level homes are smaller in under construction. We know multifamily is doing a little bit better. Is there less lumber being used right now, do you think, as far as the takeaway versus those starts from those same numbers last year? I mean, obviously we're using less lumber in a house now, right? Help me frame this question correctly.
Yeah, what you're trying to say is, hey, single family houses are smaller, ergo, how much less lumber are we using? And then the rest of the algebra equation is, how much smaller are those houses on average? That's what you need. But I mean,
yeah. So where's the demand going to come from? Is what I'm saying.
That's the real question. As we look today, as an outlook, to Kyle's point, hey, housing starts, we're going to do, we're going to do like 1,350,000, 1,360,000 this year, down 12.5% from last year. What's 2024 housing starts going to be? Are they going to be, are they going to be up? Are they going to be flat? Are they going to be down? How much are they going to be?
Yeah, so I just was on a webinar before this where Robert Dietz was speaking. He was just speaking to some investors from Benchmark. Their forecast, single family, they see that kind of bottoming out between 850 to low 900s here over the next quarter or two. And then by the end of 2024, they see that moving back into over 1 million to 1.1 million in the single family side. So basically they're saying by the end of 2024, their forecast is plus 4% on single family construction.
But they saw it to 800, 900
right,
though.
Here, bottoming out here over the next, in the near term.
I find, that's crazy. Like in the last 12 months, we built one month we built 1 million. All the rest of them were in, the 9s to, mid low 8s. So,
Then he said in 25, their forecast right now is an 8% increase from that, above that 4% increase in the year prior. So it was interesting.
Yeah, that's a single family. And then what do they do?
It's a single family number. His multifamily number is much more conservative, like because of where we are in the rental affordability and the current. We just saw 8% 30-year fixed yesterday. So
I think this will segue new homes versus existing home prices. Greg, I still got to pull that chart up for you, but that's obviously
you owe me that.
Your point. Yeah, I do owe you that chart. That the new homes obviously are the best deal out there right now, right? One, because there's not many existing homes, but two, the incentives and the availability of that coming on the market seems to be the real.
If we are in fact in a higher for longer interest rate environment, there's not going to be existing homes are not going to come onto the market in any big quantities unless there's major job loss.
Right. So you look at existing home sales. They came out today, a 13-year low.
Right.
We're going to have for the year, the number of sales is going to be the lowest, I think, since 2006 or 7. Right. And to Kyle's point, that's not going to change, unless, you would need mortgage rates probably to drop back into, I think the sweet,
5 to 6.
I think the sweet spot is somewhere in the 5 to 6 range is where mortgage rates need to be to free that market back up. We don't have a chance of seeing that unless, to Kyle's point, you have a major, significant recession in the first half of next year.
Right. Like the only way you free up housing supply is the foreclosure market goes up. The person that has a job today and that's paying their mortgage regularly, that the majority, which we have like 60% are under 5%, right? Fixed rate.
Mhm.
And there's a huge percentage below 4%. So to get them to go and say, okay, I'm going to come back in the market and look for something else, it has to get that gap has to narrow. But in most cases, it's unfortunately going to happen only in a very quick fashion, is if there's something that changes drastically to the downside in our economy that forces people into foreclosure. That's where supply goes up on existing homes.
Yeah, but the one challenge for a big change in that, Kyle, is that the loan to value right now is at an all-time record low, i.e., people have the most equity in their homes that they've ever had.
Mm-hmm.
Combination of they've got a low mortgage rate and the prices have kept going up. Every month they make a payment, blah, 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 blah. And that so contrasts the issue that we had in 08, 09.
I totally agree with you, because I don't necessarily believe that we're going to have massive job loss across the country based off the way that things are going. So it goes back to my point, is like, I think the existing home market continues to be in very, very tight supply for the next 2 to 3 years until interest rates come back down to a level that is more palatable to entice people to upgrade or do whatever.
Right. So Kyle, is a good question. And you probably have your finger on the pulse of this a little bit better. And it uses more lumber than single family or anything. Repair and remodel. Is that the real outlier that we need to look at? I'm putting a deck on the back of my house because
that's
I'm
going to
not
be a
moving
really
anytime
big
soon.
deck.
So I don't think the industry generally recognizes this. We fixate things on housing starts, but the majority of lumber consumed in North America is in repair and remodel.
Absolutely.
And that's one area that a lot of people see substantial growth, because let's just face it, like, look at the demographics, look at the supply of houses in the United States. They're aged, right? Particularly where I live in the Northeast. There's not a lot of new home starts where I live in New York or even in Pennsylvania where I used to live. It's mostly comes back of existing homes being remodeled into something. So as those existing homes actually come to market and start to turn over and resell, the repair and remodel demand heats up. It is interest rate sensitive to that standpoint, because the majority of your repair and remodel tends to happen within, I think, 2 to 3 years of the purchase of that home. So that's when you're starting to start to see some of that. But I'll share this. I was at Fast Markets RISI conference a couple weeks ago. I was on a panel.
You spoke.
I was on a panel there. And
yeah, cool.
Did they give you a discount on the registration when you speak at it? I'm asking for a friend. I'm asking for a friend.
I was trying to get a discount on my subscription, not on the registration of the event.
Oh, yeah, that would have been really.
Yeah, that's a hot topic. One of my fellow panelists was leveraging that as well. One of the things that they were talking about was repair and remodel demand, which basically has gone stagnant, if not into negative territory, the last 18 months. Mm-hmm. In 2024, they see that demand increasing by 3.1%, and in 2005 to 5.6%. Roughly, that equates to just under 40% of the lumber consumed in the United States in any given 1 year. So,
how much?
Just under 40%. It's like
wow.
It's like 35 and change, and then it's starting to grind up to 40 now. One of the things that they mention is that their forecast, while these numbers seem relatively positive, our forecast is just really assessing that we're moving back to long-term trend. Long-term trend has typically been 2.7 to like 3.2 increases year over year over year over year. Yeah. So now, and the catch-up year they're saying is 2025, which they're forecasting interest rates to be a little bit lower by then, and therefore the catch-up that we lost in 2022 and 23.
Just a follow-up on that is I was just to say, like the average age of the housing stock of owner-occupied homes is 40 years, but in New York, it's 57 years.
Yeah, is it really 57 years?
57 years old. Yeah, Massachusetts is 51. Mm-hmm.
So Ash, this was another stat I was just looking up that kind of goes back to one of your questions. We have smaller homes, we have things that are being built, but what does that really mean for actual lumber being used? Their forecast is saying, with the numbers that they're predicting, overall demand in board feet in 2024, they're going to see an increase in 3.7 billion board feet and another 3.8 billion board feet in lumber demand by 2025.
What do they show the final numbers in 23 are going to be down from 22?
600 million feet, like
So they're saying
0.6
we're going to
billion.
use 600 million less this year than we did in 22.
Correct.
But 3.7. I mean, I used to think I was an optimistic person, but I'm thinking that they're more optimistic than I am.
It was very, it was much more like typically economists are not, they're super, super conservative. This to me felt like a lot, very, very positive.
It's great data. Thank you so much, Kyle. And I just, I'm going,
that is good.
Okay, so what am I missing on that is if we got 8% mortgages, so single family next year is at, I'm going to say is that they're going to struggle to maintain this pace of single family. And that's going to be, they're going to keep trying to, value engineer. They're going to buy down mortgages, et cetera, et cetera. So that's that. Multifamily has, been very strong. Is that going to provide the growth? Okay, I buy into repair and remodeling being, 3.7% more, but it's just hard for me to wrap my head around, hey, we're going to use 3.7 billion board feet more next year than we did this year, given the environment that we're in. Currently,
like right now, it does feel eerily similar to going into the fourth quarter last year, right? Like last year, it was terrible. Like I felt from a volume perspective, like it felt like the volume that we were selling in the middle of the year. Well, we saw it in the numbers. It was like 30, 40, 50% difference in the months of November and December, particularly. And January started the year off the same in 2022 or 23.
The great thing about it, though, was there was like $100 1,000 basis to January, which, let some of us load the boat on some stuff in a very managed risk profile.
Yeah. I mean, there's items which there's good basis today going into next year. Let's face it. Like if you look at just the studs as a segment, 2x6, right?
It just costs a little bit more money to maintain that basis on the ground now.
Correct.
Well, hey, let's bring this into what's going to happen now and in the next 30, 60 days through the end of the year, right? Okay, so I have a sense out there. I've seen a lot of people saying, hey, let's talk on the future side first. They're like, hey, all the short funds are rolling, right? So to me, I don't really read much into that, except that when I look at November and I talk to Gregg about it, I'm like, is that a better sell opportunity than it is a buy opportunity? I'm getting this feeling that we are going lower before we go higher in here. Just as a feeling, Gregg always says historically, I think in spruce, we make the low in the third week in October.
Somewhere the third week in October to first week in December in that window.
So now we're fighting a seasonal like that and a lack of, I should say, optimism in the market. With all this consolidation, as we can tell, there's certainly a lot more large vendors or large buyers keeping less wood on the ground. We could tell this week because you take an order yesterday, they call you tomorrow and ask you where it's at, even though you sold it for 2 weeks or sooner. And we just sense that there's less wood being kept on the ground. It's more expensive to do it. It's the time of the year where people keep less on the ground. Are we going, and let's just talk and we'll fold into curtailments. I'm getting all these things. People are saying mills have to curtail. I mean, I feel it for mills right now. I haven't seen any substantial curtailments. If they come, they come. Who knows? I don't think they're going to be real meaningful into the end of the year. Even if there are some announcements, the feeling is that we could be going lower on most items right now. Gregg, Kyle, what's your feeling on that?
You want me to go first? So, I think the industry today is more prepared for the market to go lower than go higher. So the majority is saying that this market can go lower and I'm prepared for it. They're not prepared for it to go higher. So typically markets move in the directions of most pain. The most pain is not necessarily lower today. It could go lower, and I think it will go lower if demand goes lower. But supply is pretty flat. I would say today's market is probably more in equilibrium than we've ever seen in our history. Like we are grinding kind of lower, but the mills, the producers seem to get 1 to 2 days of decent activity every week to take care of their problem surplus. And then they just go trade back and forth for the balance of the week. And that's been like that pattern for like the last like 4 or 5 months. Yes, and it's kind of ground lower, but it's back to where we've had, long-term support, at least over the last few years. Yeah, we can definitely go lower, but I think the question is, when are we going higher? And as people ultimately prepared for that, because the volatility that we have today is virtually non-existent. It will be like that, but that will change. I'm not sure there's a lot of people really putting any long-term plans to get in place to make sure that their risk is off the table.
Yeah, I love that you quoted. I mean, market does what causes the most people the most amount of pain and suffering, and you're absolutely right. I've kind of been in this place going, well, yeah, in order for the market to have a substantial rally, it probably needs to go lower. And I'm talking spruce right now. If I'm talking pine 6 and 8 inch, if you're a pine 6 and 8 inch buyer, you know what? You should have whatever you can physically carry in your yard for 60, 90. I mean, your downside risk is really minimal. But if you're talking spruce, I'm actually in this viewpoint that sharply sideways is what causes the most pain and suffering, because you can see there's a whole group of traders out there that are kind of chopping themselves up. If they get aggressive selling, they chop themselves up. You can't spec buy. As you know, it's been a really, I'm not going to say great, but it's been a good market for distributors. Those of us that carry inventory, can provide the heavy mixes, can sell trucks for 2 weeks or sooner. And then when guys say, where is it? You go, yeah, it's loaded today. Right. I mean,
we're in the distribution business, so we trade heavy to the long side. So I'm always going to have this long bias in the sense that there's value at some point. But we've been able to, in this marketplace, the value of having inventory has been profound, because people want to buy more regularly on smaller quantities, and so that's fit into the business model that we supply. At some point, they're not going to be able to buy everything they want that way. And when is that? That's the $64,000 question. We don't know exactly when that's going to happen. My feeling kind of going into this quarter and into next year is, I've always said, we need the Fed to tell us that the interest rates are going to stop. But then I really started to think about it. So we don't necessarily need that, or lumber doesn't necessarily need that to make a move higher. What really needs to happen is that the demand starts to show up in small incremental changes to the positive side, meaning that the builder says, okay, well, my forecasted sales for the spring or what have you are starting to look like this. Maybe I want to go and speculate on a small percentage higher. And it only takes 1 or 2 extra homes being built, 1 or 2 extra truckloads being built to change the sentiment in a marketplace to make things go higher. And lumber is always the first thing to go up and the first thing to go down. We saw it in the beginning of the pandemic, the end of the pandemic, and we're 17 months now of what I would call where the two major data points would tell us of that we're in this bear cycle. And typically bear cycles are 15 to 18 months, generally speaking, unless you go into a really, really deep recession, which it seems like we could, there's that possibility, but it seems like we're not. We're closer to the end of this bear cycle. And at some point in 24, I believe we're talking a different story.
Kyle, you hit a good point. You're getting paid to be a distributor right now. There were years, if you remember, where you had to sell at a discount to carload pricing to get trucks and beg for it, right? And now you're getting carload plus still. Like Gregg and I, every Saturday, if we're in here or whatever, we're like, wow, that was a good week last week. We didn't expect that. And we did this over and over and over again. So, maybe I'm just waiting for another shoe to drop, but things just continue to kind of like plod along with decent volume so far. Gregg, does that sound right?
Yep.
And if I say, does that sound right again, my wife's going to kill me because she says that sounds terrible when I say that.
Stop saying that. Yeah. I think that, the point at this point is that seasonally we're moving from negative to a positive standpoint. Price-wise, we're we're in the bottom 10 percentile of price range. So the net's pretty close, but we could be in for a period of sustained sideways action that just kind of bleeds you, means that the cost to carry, it's going to bleed people out. But to Kyle's point, until we hit that tipping point, when will it be? Will this be the year where, the market doesn't really go anywhere until, late February, March, and then we have a monster rally into Q2, right? Or will this be a more traditional year where you get a decent rally somewhere between now and our Thanksgiving, and then you've kind of flatlined till the end of the year, and then you have a move in, January into March, building season, very historical seasonal trade, right? That's kind of the question that I keep asking. Which kind of year is it going to be?
Yeah, that's a good question. So we are talking to buyers out there, Gregg, what do we like and what don't we like in the market? And I shouldn't say what we don't like. So it's not that I don't like 2x4 16s, but man, that trade has just run and run. I mean, that fish took out line for a long time and it continues to take out line. So I still consider that now. I guess if I looked at a chart, it probably is fairly to a little bit overvalued, but from where it came from, I'm going to say it's overvalued. I don't like 2x4 16s that much. I love in spruce. I love 2x6 16s. I'm going to keep saying it, but they just can't get off of the mat. So those are the things I like and don't like. What about both of you? What are you thinking as far as items go?
I can tell you 2x6 16s remind me of 2015. I was very heavy in them in the fourth quarter, and the trade didn't come together until like the second quarter of the following year. But it worked out amazing, like when it happened. But it took a long time on 2x6 16s as a just a rule of thumb. I think studs are the items to look at. Not 8-foot studs, but 9-foot studs probably are things that people should consider looking at.
I'm going to go on with something, we talked about this, 6, 8, 10, 12 weeks ago for like week on week, things that we hated, 2x6 9s and 10s. I'm going to tell you now, those are things you need to start to seriously look at. Those have come all the way back in, particularly on 2x6 9s, which we know is a big multifamily item. It doesn't take too many jobs. As we know, now the mills are going, well, we don't need to make a whole lot of that because it's been hard to sell. Right. Mm-hmm. So yeah, I'd say 2x6 9s is something in full transparency. I have been buying. I started too early. I just want to let you know, because if you're not early, you're late.
They're a good value in multiple species, Gregg, too. Like in Doug fir, hem fir, this 2x6 9s are a very good item to look at.
Yeah. On the other side, I mean, you highlighted 2x4 16s. They are overvalued, but they're still a good value from a transactional standpoint. I think they're going to continue to maintain some value until enough European 16s get dropped on the dock and they squash it. And I don't know if that's next week, 3 weeks from now, or the second week in December. Could be the second week in December, just a whisper. 2x4 8s, they're way too much. They need to come down. Yeah. 2x4 8s are $50 to $75 overvalued.
2x4 12s and 14s. 14s, we got a little action yesterday, but 12s and 14s still look decent on the 4-inch side. Does that sound right, guys?
12s are dirty cheap, and
12-footers
are dirty cheap.
Yep.
Well, great, guys. I appreciate it. Kyle, thank you so much for coming on.
Really appreciate it.
That was some solid information.
Thanks.
Like
I told you, Ashley, we had to get Kyle on, man, because he's
I know. Like I'm like changing my mind on a few things now. Like Kyle, I feel better about a lot of things now.
I mean, it's not doom and gloom, Ash.
I'm just circling.
I hear you.
Absolutely. For next year, I put that circle here. I'm gonna like.
There's a lot of opportunity out there, which is really, really cool. I do have just a couple questions. Can I ask a question in regard to
sure, yeah,
in regard to our new mini contract that we now trade? What are your guys' thoughts on the current breakdown of open interest in the it's doing what it said it would do. We are getting more participation, at least. It's not from a weighted average. We're not necessarily transacting more volume in the exchange, but having close to 9,000 today, a lot better than what we've seen in the last few years. What are your thoughts in regard to that?
I mean, I think in terms of open interest, it's kind of right back to where the average normal had been prior. The low level was it dropped down to like 16 or 1700, which would represent 6,500, and you got, if you got a high level of 2,500 would be 10,000. I'd love to see it regularly carry a 10 to 12,000 open interest, because given all the things that we did to expand access, that's what it should be generating. I mean, the makeup is interesting, and in that you've got the majority, 40% of the open interest is funds being short, the industry being long.
How do we get more producers to trade it? Is my question. Right? I mean, we adjusted that for
any producer, but who cares? Who cares? I mean, anyone listening, if you can edit this if you want, Ash, but I wouldn't. Who cares, right? People that understand that we are in a volatile business and that risk management should be a part of their business strategy should be trading futures. Everybody.
No, everybody. I agree. But from what Kyle's question was, the new contract, we did it to be more inclusive of all the mills, especially Eastern mills. All the hem fir mills now can use it. So I'm wondering, at some point, will they use it? I think it's a great contract. I think it's working real well. And Greg, to your point, we use it all the time, and it works for us. So
I don't care about what anybody else does. Oh, did I say that out loud? I wasn't supposed to say that out loud. Shit.
But we like it, and we think you should too.
I will say that I think, all things considered, we just went from a market that went from in the 1500s down to now really like a 300 mil base, or 500 Chicago.
Yep.
The fact that we have close to 9,000 open interest in an environment like that, I think is really good. So what does it do when we actually have more volatility? I know that could scare people away, but I'm thinking that we could get some broader participation from that producer side, because I have had some questions from not Eastern Canadian mills, but Pacific Northwest mills that are now like considering doing some other things. So, and it's not coming from the sales team, it's coming from like the accounting department, from the CFOs of the world and what have you, which is, that's nice to hear. And we are getting, transitioning from an older sales and generation to the next guys, and they're trying to see what are the things that we could possibly do differently than what we've historically done.
I think, Kyle, a lot. Look at our industry. There's a lot of people in here that are always pessimistic about things. It seems to be the nature of some group of people, and I think a lot of them are waited for the contract to actually be successful and to start trading, because there was a faction of people out there that didn't think it would survive, right? And it did, and it's doing really well. So now, with that said, now we need more. That I think alone will bring more people, and I think we're kind of seeing that right now.
So I'm pleasantly surprised. Hopefully, we can continue to get it more. To Greg's point, it doesn't really matter where the participation comes from. If people that can identify it as a tool to go and manage their risk, by all means, let's help them get in there and use it.
My trading advice today, and don't take this as anything more than the grain of salt, is the spread between November and January is held very, very tight in here as a result of substantial fund rolling pressuring that. The industry that's long November, this is a really good time if you need to extend that risk management into the first quarter to get it done. Mm-hmm. Because historically, November is something that expires pretty weak. And January typically carries a pretty good premium, particularly when you're on low level prices. So
right.
I just want January to get back to that $100 premium it had last year. Where's that 100?
Well, sorry, don't have that.
Yeah, that's not going to happen.
No, but there is obviously still a lot to roll. What do we have? 5,000 in the front today, and there's 4,000 short in that front, likely in one area. It'll be good.
Yeah, that's a big chunk, isn't it? I mean,
it's probably down. It's probably the funds are probably down at like on 3 or less, because they've been rolling all week, 200-300 a day. So
it's good though.
Kyle, hey, great to see you. We'll look forward to seeing you. You're beautiful downtown Columbus, Ohio.
I'll see you in Columbus, Ohio in a few weeks. Thank you, guys.
Thank you, Kyle. That concludes episode number 12 Kyle Little from Sherwood Lumber, Gregg Riley, Sitka USA. Appreciate everything. Look forward to being here next week again. Thank you for continuing to support us and listen.